Well, so far has been nothing short of.
The word that would best describe them, I think, would be trustworthy.
They're just a fantastic group of people.
We have a fantastic team in Alpha Wealth. We're all fully qualified individuals with over 60 years of combined experience between us.
I've spoken to so many different people that they feel like they've just like an extra cousin I've never met before, and they're always there with a kind of a helping hand to do whatever I need.
They have a very professional approach, and you feel like you're getting advice that you can trust and rely on.
They're a company that I would definitely recommend to friends and family. Nick and the team are there at the end of a phone or at the end of an email, and they will always come back to you.
Alpha Wealth provide a full range service to our clients' needs, just to make sure that you're doing the right things for you and getting the most from your own money, getting it working harder for you and ensuring that your family are protected.
Good afternoon, everyone. Thank you for joining us for this presentation this afternoon. For those of you that don't know me, my name is Nick Shellambus and I am the Managing Director of Alpha Wealth.
Good afternoon, everybody. My name is Cleanna O'Donoghue and I'm the Business Development Director of Alpha Wealth. Thanks for joining us today, and we're joined by our colleague Keenan Cunningham, who is the Marketing Manager. Thank you.
So we're going to spend the next 25 minutes or so just running through some areas for business owners, directors and senior managers. As a business owner myself, I feel I've implemented a lot of the tips that we'd like to give you today, and hopefully you'll find this session very informative and useful. And I suppose if you are listening to this on playback, it is mostly timeless. So all the areas that we talk about today, you can implement regardless of what time that you're listening to this. For those of you that aren't familiar with Alpha Wealth, we currently have 8 qualified individuals based primarily in Cork. We have 1 or 2 based around the country, and we work nationwide providing personal financial advice both to business owners and to individuals of all types, whether you're POE, self-employed or run your own company.
So Nick, can you just provide us with a brief background into the topics that you're going to cover today, and I suppose the takeaways that people can leave the webinar with?
Yes, so there's basically 7 takeaways that we're going to run through, starting with helping you work out your goals and separating them out into 3 separate parts. We're also going to help you talk around reducing the tax that your company pays, creating personal wealth, and the tax that you pay yourself as an individual. Well, I'm going to focus on getting your savings working harder, protecting the individuals in the company, yourself and others, as well as succession planning, and finally finish off on a small bit on company cars. Again, it's going to be very high level, and please do feel free to ask any questions. We are going to pop up a poll, just if you wouldn't mind filling in during the course of the next 20 minutes or so, just in terms of helping you decide what you'd like to hear for any of future webinars we do going forward. One of the things to mention as well, of the takeaways today, we've done a series of webinars that are completely complimentary that you can access on our website, and we would encourage you to do so. One recently on reducing the tax that you pay, and I do think it's certainly an opportunity if you are listening to this in December 22 to avail of before the year end. So I'm just going to start with helping you to decipher between different things that you need to plan for. And I like to categorize them by short term, anything less than 3 years, medium term, which is 3 years to retirement, which can vary obviously depending on your age, and then longer term, typically your retirement years, which could be anything up to a quarter of your life, obviously depending on what age you decide to draw down your benefits for. So I'm just going to talk briefly around one of the most powerful tools available for any company owner or senior manager, which is your pension scheme. Now, before you switch off this video, I suppose the key thing to remember is that as a business, and certainly in my position, getting money out of your company tax effectively, once you reach the threshold of high rates of tax, which will be 40,000 from January 2023, you really need to think about the cost of drawing excess salary, which is 52%, and looking at other opportunities. And pensions are a really great way of getting money out of your company. The company doesn't pay employers PSI, which is a further 11% saving. But more importantly is that you do not lose money to the taxman and get the money into your name, albeit ring fenced in a tax-free pension vehicle, and you draw it down from any age from 50 onwards.
Nick, isn't a pension just a delay really in paying tax when you retire?
I've been asked this before by many people, and albeit that there is some tax implications for the pension that you build up, the thing to remember, guys, is that you're saving tax at 52% by putting it into the pension fund in the first place. And the money in the pension grows tax-free. So for me as a 49-year-old who's looking to draw their benefits at approximately 63, because that's the age of independence of my youngest child, I feel it very important to make sure that that money can be utilized. You are entitled to 25% of the fund tax-free, and I really think it's a great opportunity. And therefore, the tax that you pay is far less significant than the tax that you save. I'm just going to talk briefly now about how much you should aim for in your pension. And now this is a separate webinar, and again, the video is available to anybody. But typically, I talk about two numbers: 400,000 and 800,000. 400,000 is the figure that I use typically to give you 100,000 tax-free when you draw your benefits, and then the remainder can give you an income of approximately about 24,000 a year. When you add in the state benefit, you're getting very close to the higher rate threshold. The reason I use 800,000 as the next target figure is that many business owners, or indeed senior managers, are in a position where they could build up quite extensive pension funds, and they're not really sure what level to reach. And again, in my professional opinion, I feel that 800,000, which will give you a tax-free sum of 200,000, which is the sweet spot, because it's the maximum tax-free you can take from your pension fund, and leaving then the 600,000, which will generate an income very conservatively of around 36,000 a year. Again, in most cases, adding the state pension to that.
What about somebody, let's say, Nick, that's on the call today that may not have a pension in place, and 400k seems like a big pot to aim for?
I suppose the only thing I say to people is that pensions don't have to be the be all and end all. We come across individuals who have rental income, which they see as a form of pension, and also other assets. And I met a client recently, a GP, who was actually 66, believe it or not, who hadn't started a pension scheme, but was looking to work until 70. And the difference for them is that by making any payments into the pension, and they actually put in 10,000 euros before the tax deadline earlier in the year, in November, and saved themselves 4,000 euros in tax. Now, the key thing to note, guys, is that if you put 6,000 euros into your pension and the government bring it up to 10,000, that's a 66% return. And then all it was going to do for that GP is that it was going to enable them to build up more money on top of their practice and also rental income that they were in receipt of. So it was really just a great savings plan for them. I'm just going to talk briefly about savings, guys. And I mentioned earlier about the medium, long-term and short-term pots. And I'm going to focus briefly just on medium term. This is anything from 3 years upwards. And I suppose the key message on the slide that you can see here is that if you're looking to, say, build a fund of 30,000, which could be used for a deposit for a house, buying a new car, getting married, helping your children through third level, and let's say you've got 4 years to raise that sort of money, you've got two options. One is that you do it through the traditional means like the bank, post office, credit union, and realistically, you're not going to earn any interest, and therefore you need to put in about 625 euros a month. However, if you can earn 3.5% interest, which we feel very strongly about, we can provide accounts that will do that. You only need to save 570 euros a month, which is basically saving you 55 euros a month. If you happen to have a lump sum, let's say the example here of 8,000, it reduces the amount you need to 400 euros a month. The key message is it's getting growth and it's getting a return on your savings, and it's the compounding effect. It's what Einstein called one of the most powerful forces in the universe, and this is exactly that same principle. The example I'm going to give today is a fund through Zurich. It's a really great savings plan. We feel very strongly that it can give you growth of around 5% per year. We offer it under no exit penalties. You can access the money at all times from day one to 50th anniversary of the scheme. It's totally open, and we reduce fees significantly for our clients. We'd like to suggest that we are the lowest cost provider of this account in Ireland. And if you indeed have a savings plan, it's worth checking in on the fees that you're paying, because not all accounts have the same fees. And having worked in the industry for 25 years, I can tell you categorically, I worked in AIB for many, many years. And for an accountancy practice, the fees that we charge clients were significantly higher.
So Nick, sorry, before you move on, can I just ask you, with all of the uncertainty out there at the moment in the markets, is there a fear that people could lose money in these funds?
You can see the table on the screen there, and we always allocate these accounts to someone's risk profile and what they're looking to achieve. Now, again, at a high level, risk runs from a scale of 1 to 7, and most of our clients find that they're not having the right balance, in that they have a lot of money sitting in kind of non-interest bearing accounts, which would be a risk profile 1. And our role is to help them understand that over time, they should allow themselves the opportunity to get higher returns. And yes, there is a certain element of risk, but it can be very small. An example I want to show you here is that this is one of the accounts that we've run for the last 8 years since it was launched. And you can see on the screen there that despite recent poor performance, which we've witnessed because of Ukraine, rising interest rates, fears of global recession, the fund has annually returned over 3 years, 4.4% per annum. That's at the bottom of the screen there. Over the last 5 years, again, it's annualized 4.5%. And over a longer period since it launched 8 years ago, 6.2%. So the message I'd give everyone is, it really makes sense for you to invest your money, even in low risk accounts that can give you a positive return over time. And the main, I suppose, enemy to you at the moment with savings is inflation. Inflation is rocking at around 6 to 8% at the moment. And unless you're earning rates that get close to that, you're going to be losing money in real terms. I'm just going to talk about one scheme from a personal perspective called the Employment Investment Incentive Scheme. And again, I don't want to keep going about videos, guys, but we did a really good video recently. I would encourage you to listen to it if you are a higher rate taxpayer, as a business owner or senior manager, where you can invest 10,000 euros as an example and get 4,000 euros back from the revenue. The illustration shown on the screen here shows that for a 10,000 contribution into a qualifying company, and we showcased 3 really good companies recently on the video, that you can get typically about 12,000 euros back in a period of 4 to 5 years, which is a double your money investment.
So if you are, sorry, Nick, a business owner, and can you get your company to pay into this EIIS scheme for you?
I suppose the interesting thing, Cliona, is that no is a short answer to the question, in that it has to be paid personally. So again, Nick Sherlams of Alpha Wealth cannot use Alpha Wealth's money to invest in the EIIS scheme. But the way I've worked this in the past, an example of how you can be quite clever in the way that you manage your finances. Let's say you're on the threshold of 40%, 40,000 a year. So you're not paying tax at a high rate, and may feel then that the scheme doesn't qualify for you. You can draw a bonus from your company. Let's assume that your company has 20,000 euros sitting in the bank idle, and you put that money in, take that money out, sorry, as a salary. So you take out 20,000, obviously now incorporating tax at the higher rate, you will lose 50% to the taxman. You would net 10,000 euros, again illustrated on the screen. If you were to invest the 10,000 that you're left with, you would get your 4,000 back from revenue in the following year, which is the illustration we gave earlier. And also then you look to earn the 12,000 at the end of the 4 to 5 years, hence netting 16,000. Now, if I said, well, a business owner can get 16,000 out of their company by drawing 20,000 gross, that's a 20% tax rate, instead of taking money out of your company and paying 52%. And that's how you can use these tools cleverly. And the only thing you've had to do is wait 4 to 5 years, which many businesses...
Sorry, I didn't mean to interrupt you. But on that, Nick, so let's say you have somebody who's getting a bonus this time of the year of, let's say, 20K. Would you invest it in a pension, or would you advise to, maybe consider looking at EIIS, or particularly maybe the saving schemes that you discussed? What options or what advice would you give on that?
Yeah, I mean, I think this is why people should engage with a financial planner. Some people perceive financial advisors as being high cost and, I suppose trying to push product, but a lot of what we do is help people with the balance. So typically, I suppose you're right, there are three strands. So for anyone who has money, we basically lay this out on what we call a menu board, where we focus on the most tax efficient investments first. Have you utilized your pension opportunity? Have you looked at EIS? But then you may need requirements where you're going to need access to the money, which is where the likes of the Zurich account fits in. If you've got children going to third level college in the next number of years, you can't put money into two long-term instruments either. So again, the short answer to the question is, I would suggest that it really comes down to balancing, and that's where we feel that we're very strong at, in helping you not only understand the best vehicles available, but also then in how you tailor them. And more importantly is that you review them at least once a year to make sure that you're on track. I'm just going to move on to a very quick example of the tax-backed scheme. Again, I'm not going to focus too much on this today, but there is a court-based company called Blacksett Kinsale, valued at currently 15 million, turning over actually 3 million this year, 2.1 million last year, and they made a profit last year of 625,000. And they're one of the three companies that we showcase in the scheme that are paying up to 28% interest over that 4 to 5 year period, with the 40% from the government as well. Again, if anyone is interested in that, please do feel free to come back to us. And I would encourage you to ask any questions on the Q&A if you would like to answer. I will cover them off at the end of this presentation. For anyone who is looking at these types of schemes in terms of saving for, I suppose, protecting yourself either in life insurance, serious illness, or income protection, as a business owner, I feel that your company should be paying for everything barring mortgage protection. So if you've taken out a mortgage, there is a legal requirement that you pay for a mortgage protection policy personally. And as I put up on the screen there, I believe that for 99% of us, we shouldn't be paying more than 25 euros a month for this. I've come across so many clients that are basically oversold this, and it's incorporated a lot of additional bells and whistles that blatantly they can get their company to pay for, indeed, if they actually need them. And this is where the discussion piece, I feel, is really important. As well as that, your business can pay for life insurance, get tax relief on it, and it's paid directly to your estate in the event of your premature demise without any benefit in kind. It's a really great plan. I tell any business owner that I come across, you really should look at affecting this. Not to labor on this, guys, but if you have employees, and let's say you run a company with 3 or more employees, including yourself as the business owner, you can get group savings, and they are significant discounts where you can get 4 times salary, death in service. You can protect incomes, typically up to 50% of the individual cost if you were to buy it. And also next year, 2023, it's going to become compulsory for you to pay into a pension scheme for your employees. And it's about, I suppose, positioning yourself and maybe getting slightly ahead of the curve in terms of how this would work for your business, and starting to kind of factor this into, I suppose, your employee benefit program. But the biggest focus really for the business owner is to understand that if you have life insurance, if you have serious illness, and if you're paying for it, even if the company's paying for it, if you want to include 2 or more members to the scheme, you will save the cost on just paying for yourself. It will end up cheaper. There's no medical forms, and it's certainly a lot more comprehensive and certainly robust, in my view, than an individual policy. I'm just going to talk briefly in relation to succession planning. And this is an area really when business owners start to become ingrained in the business, and they see themselves as the business. And I keep saying to people, when I talk to business owners, you need to sort of consider yourself having 2 hats. You've got your personal hat and you've got your business hat. And really it's trying to get that differentiation. So taking money out of the business into your pension is moving from one hat into the other. The 2, I suppose, areas I'm just going to touch upon today are called entrepreneurial relief and retirement relief. Now, I don't need to get bogged down by the jargon, but basically a business owner that gets to a certain age and they want to sort of get out of the business, one of the reliefs available to them is to sell the company, and the first €1 million that they sell the business for is a reduced tax rate of 10%. The other relief that's available to people is that if you've been employed by 10 years or more by your company, i.e. you've taken a salary, and let's say you have a partner relationship, where your salary for 10 years from age 45 onwards, you can take up to 750,000 tax-free from that company. And obviously with a partner, that's up to 1.5 million. You might say, well, what's the relevance of that? Like, I'm only in my 30s, or okay, I'm in my 40s, but that's at least 10 years away. And I suppose the key thing then is it's about planning. It's about lining your ducks up and saying, okay, well, I understand that, from 45, I need to continue to draw a salary, because if I break the salary, I start that 10-year process again. And knowing that from 55, you could draw out 750,000 from your business, possibly up to 1.5 million. So therefore, you may then decide to think differently about whether you leave money in the company. And again, it comes back to what we said earlier about balance, making sure that you're balancing out the various different, I suppose, vehicles that are available and getting the most from them. Lastly, I just wanted to touch on benefit in kind for company cars. Now, I have a company car and I pay benefit in kind on that. And many of you may be aware, but from January next year, 2023, there's going to be an increase in the rate, moving from 6 to 9% as a minimum rate, up to 37.5%. And not only is the rate increasing, but also it's not just based on the number of kilometers you do. It's going to be based also on the emissions. So I suppose the key thing really is firstly to understand this, and then it's a case of, well, okay, what can you do? So for anyone who is looking to get a car, I actually got a car earlier this year. It's trying to make countenance of, okay, would it be better to perhaps get a cash allowance instead? Because the attractiveness of a company car is lessened, obviously, the fact that you're paying more BIK. The other thing is that it's about saying to yourself, okay, well, what can I do about it? Well, obviously, I know it sounds really obvious, but buying a cheaper car may be an option, rather than going for a really big car that's very expensive. And it looks as well that legislation seemingly over the course of the next few weeks will be based on the size of the car as well. Car with lower emissions obviously is an obvious one, doing a lot of kilometers. So look, again, I appreciate it may not suit everybody, but the more kilometers you do, the less BIK you pay. And then lastly, whether or not there's an option to get a commercial vehicle instead. And personally, I had looked at commercial vehicles. It didn't work for me because I had kids, so I needed kind of the 4 doors. But there are some very great commercial vehicles. A friend of mine actually got the same car that I have as a 2-door, and it's classified as commercial, and they have no BIK on that. So again, it's really just about navigating kind of these situations you find. The last thing I do want to touch on, and again, please put any questions into the Q&A, is that we are offering a discounted full financial review where we are offering business owners, senior managers and directors a financial review where we can look at both your personal and your company holdings, saving you thousands of euros on the cost of your mortgage, giving you independent advice on things like health insurance, helping you understand where your pensions are. We're not looking to try and sell you these products. Our role really is to act as advisors and help you understand where you are, but more importantly, where you're going. The biggest objective that I have for most of my clients, particularly business owners and senior managers, is helping them reach financial independence early. So for me, my scenario is that because I have an 8-year-old, I am looking at drawing my, I suppose, benefits from pension and other assets at 63. For some of the people, it may vary. They may want to get out at 50. They may be happy to continue working, but it's about having the choice rather than the financial need to do so. And we provide cash flow modeling tools for that. Some of our competitors, by the way, charge anything from, and don't mind the 1,000 euros you see there, 5,000 euros for company reviews. And if you want to any guidance on that, I can show you. There are businesses out there, the likes of Ask Paul, Prosperous Financial, which is Owen McGee, who I worked with previously. And we're not knocking those providers. What we're saying is that we feel very strongly that we can give you even better advice at a much lower fee. And it's really just about making sure that you are checking in. And indeed, this time of year, I say to people, especially if you are planning for next year, just make sure that you're planning effectively, looking at what you could perhaps do differently. Did you achieve your financial objectives? Because it has been a really challenging year for all of us, from rising interest rates to rising energy costs, both from a personal and business perspective. All I'm really saying to business owners is do the best you can. And if you think it's a lot of hassle, Our role is to make it really simple. The only thing I ever ask of anyone that we meet, and same for my colleagues, several managers in Alpha Wealth who can assist you, is just to allow us to do the job that you've instructed us to do. So we ask you to sign an authorization. It doesn't cost you anything or obligate you. And what it does is it allows us to get the information for you. We tabulate it, and then we start to give you some recommendations based on what we see. We work through DocuSign. There's no hassle. It's a really simple process. And 99.9% of the work we do can be done by someone sitting at a desk at a time and day, evening, whenever that suits them. So
And I just asked there, Dick, the EIIS scheme, just to confirm, is that government backed? And are there any risks with it?
Okay, so the EIIS scheme, and again, we can give you some information and send on the slides from the recent webinar, is that the government guaranteed the 40%. So an example of 10,000 euros, the 4,000 euros back. So we narrowed down the 70 so companies that look for this finance every year to the best 3, and we showcase those, as I mentioned. The investment that you put in, so in this example, the 10,000 is not guaranteed, and it's based on the ability of the company that you lend this money to for the 4-year period to pay you back. We feel very strongly by giving you the options of 3 companies, by giving you the information, including the company balance sheets, giving our steer as to why we felt that these companies were the best, without bias, I should add, that this is a fantastic opportunity in a period where it's really hard to make money. You know, the days of getting, interest from banks at 5, 6, 7+%, they're not there, and they're unlikely to be there for many, many years to come. So what we're really trying to say to people is don't look a gift horse in the mouth. I'd ask you just to make sure that you're at least aware of the scheme. It's likely only to last for another 2 to 3 years, and make sure that you get independent advice and guidance about how it can suit you.
So the 1,000 voucher that a company can provide to each employee, is this also available to directors that are not employees? If a director needs to be an employee, what is the minimum salary that they would need to be paid to qualify?
That's a really good question. I actually don't know the answer to that. What I would like to do, though, is I'd like to clarify. I don't want to give you an answer that I think, but I'm not 100% sure of. So if you wouldn't mind, if you could maybe forward on the question to me directly. My email address is nick@alphawealth.ie. I will get the answer to the question and respond to you. As I said, I just want to be 100% sure before I give you a definitive on that.
In terms of pensions, Nick, what's the maximum that someone can put into a pension in a year?
This is the beauty of pensions for business owners and for senior managers. If your company, so again, if you're a senior manager where you earn big bonuses, or if you're on a very large salary, if you have the ability to ask your company to make some contribution into your pension instead of the pay rise or the bonus, your limits are enormous. So for a business owner, you have typically the ability to pay somewhere around 150% of your salary each year into a pension scheme. In some cases, it can be vastly higher than that. Whereas personally, so for Nick Charlambus as a personal individual, I'm limited on a percentage of my earnings so that I can contribute. Now, for most business owners, I suggested to them that they shouldn't be paying into their pension. Let their company do it for them. The best way to get money into a pension is directly from your company. It's avoiding the USC and PRSI, and it's a way of you remunerating yourself in addition to any income.
And in terms of the Zurich savings scheme that you mentioned, is there a set number of years that you should kind of think about leaving your money there to gain the maximum benefit? Or like, what's the minimum, I suppose, number of years that you can leave the money there for?
I honestly think the Zurich savings plan is something that everybody listening to this call should do. The minimum contribution is 100 euros a month. And if you can't afford to do it, talk to us and we'll show you where the savings can be found to do so. We save people thousands of euros, and I mean this, on various different plans that they may have, from life insurance to their mortgage to other areas. But the reason I feel it's so strong is that there's no limit to how long or short you do it for. I've had clients do it for 6 months, and I have clients who started 8 years ago that I fully intend on keeping it going. And there's always going to be reasons for us to save for different things that we want to do in our lives, whether it's go on a nice holiday, whether it's buy a bigger house, a bigger car, whatever it is. But to answer the question, Clea, the normal time frame that we ask clients to invest for, save for, is 3 years plus. And the reason I say that is, as I showed on the screen earlier, that's typically the period that is always shown to provide a positive return. So we wouldn't want somebody to knowingly do this for 6 or 12 months and find that because of the fact that maybe they weren't in the, I suppose, the best performing fund, which again is what we help them to decide, that it may have lost some euros for them. And hence over 3+ years, it would typically always give a better return.
And just in the manner, I suppose, of transparency, can you just discuss really, I suppose, the fees associated maybe with the Zurich savings and also with the EIIS scheme, if that's okay? We might finish up on that unless anybody wants to pop any more questions into the Q&A.
So I mentioned earlier that I'd like you to see us as a low-cost broker, and we're very transparent with our fees. We are regulated by the central bank, so we will provide you with a summary of what the recommendation was, inclusive of the fees, and spell them out specifically for you. Typically with the EIIS scheme, the fee is between 2 and 3% of your investment contribution. So if you put in 10,000, the only fee that Alpha Wealth will earn is €200 typically on the scheme. And that's a once-off all-in fee for the period of 4 to 5 years where we manage and we give you all of the guidance throughout that period. In relation to the Zurich savings plan or the Zurich investment, the fee is typically 1.35% per annum. It's a reduced fee. There is no broker in Ireland that offers a lower fee. They can't, because that's the base fee that Zurich charge. And we allow 100% of the client's funds invested and cover a 1% government levy, which again is the highest that people can achieve. You might be saying, Nick, well, if Zurich get the management fee and if Zurich get, you're covering the government levy, how do you get paid? Basically, Zurich pay us as a broker. They only deal with brokers. They're not a client business. And they pay us a finder's fee based on the future expectation of the income that they'll earn on the management fee over a few years. Now, if a client exits within 4 years, I don't get paid, but that's fine. It does provide an incentive for me to obviously make sure that the plan is working favorably for people. But the thing is, again, we like to think that we base our relationship with people on longevity, and it's about making sure that we are steering them in whatever area. And if anyone has a very simple question, even I popped up on the screen here, areas in which we give advice, we'll happily give that to you. Feel free to email me. I'll happily answer any questions for you trivially. The €99 that I expressed earlier is for the full financial review. It's helping you in terms of any specific areas that you'd like some guidance and assistance with. And if we don't justify the fee, guys, I'll waive the fee for you. Genuinely, I'll pay it back. We're not looking to try and get money off people that don't feel that they actually deserve, that we've deserved it. I just wanted to maybe finish off in terms of things that people were interested in on the poll, and thank you very much for answering the questions. It seems that the biggest winner is how to grow your own personal wealth, so we will take that on board, and certainly that may be one that we look at early into the new year. And please do look out for the webinars. And again, for those of you that have attended some of them this year, we'd like to thank you. And obviously, again, it's great to have the engagement. We'd like to obviously suggest that, we'd love to work with you in the future. If anyone does have any further questions, they do want to put them to the Q&A, we'll leave the chat open for you for a little bit longer. And obviously, do feel free to do so. And just say thank you again to all of you for your time this afternoon.